We've discussed all about buying stocks and analyzing them, but it's equally important to know when to exit these investments. This could be driven by personal needs or by market movements. Here's a list of things that you should keep in mind before deciding this.
Always stick to your price targets. Don't follow the herd on stock moves. Maintain your asset allocation depending on your risk profile. Review your equity investments regularly and book profits when deemed fit. Do a stock-specific analysis in case you need to cash out of some of your equity investments. To understand better how to carry out the fundamental analysis of a company, we are joined by Nitin Jain, CEO Capital Markets Edelweiss.
Thanks very much for joining us, Mr. Jain. My first question is, how important is the sector or industry of the company that you want to invest in terms of the fundamental analysis?
It's very interesting that in certain sectors, even companies which are not doing very well in terms of their business performance seem to grow significantly. So IT, for example, if you look at some of the laggards, even they are billion-dollar companies right now. Companies like Mphasis, companies like even Polaris and all, they've struggled vis-a-vis the leaders in the market, but they're still greater than a billion-dollar company, some of them. Whereas if you see some of the other sectors, for example, airlines, I mean, that sector is always under headwinds. I mean, even the best performing companies in that sector are struggling to reach $1 billion mark, and they're finding it so difficult to become profitable. Except for Indigo, I don't think there is anything which is even close to profitability. So it's important for you to know which are the sectors where growth and demand is a given, and which are the sectors which are constantly battling against headwinds. But these are the big calls that you make before you start picking up stocks. Just because a stock is in the right sector does not mean that it will do well, but I would always prefer a slightly weaker stock in a good sector than a strong stock in a weak sector.
There are several valuation ratios that we use while doing a fundamental analysis, but how should all these ratios be viewed together before choosing a stock?
See, different sectors and different companies need to be looked at differently. So for example, if it's a very capital intensive company, or if it is a capital based company, for example banks, financial services, one of the key things to figure out is the capital efficiency of the company. So what does that mean? What is the kind of return on equity that the stock has been delivering for a period of time? Return on equity is probably one of the most critical ratios that you should look at when you are evaluating a bank, or when you are evaluating an NBFC, when you are evaluating even other capital intensive businesses. What is the kind of debt to equity that the balance sheet is currently supporting? Because it's a very tricky one. A lesser debt to equity means that you are not optimizing your leverage. A higher debt to equity, you run the risk of not being able to service that and, you know, weakening your balance sheet. There's another very interesting parameter that we track very closely, that is called as asset turnover ratio. Any business which has an asset turnover less than 2 will always struggle to be profitable over a long run.
Can you just explain asset turnover ratio? How is it defined?
I'll give you a very simple example. Let's say I'm running a shop, a small shop. So the cost of the shop and the cost of my inventory, let's say that is my fixed asset for the time being. What is the total revenue that I'm doing? Let's say the cost of the shop and the cost of the inventory totals up to $100. And if my sales for the year is, let's say, $150, so my asset turnover is 1.5 times. Okay. Now, to run a good business on this 100, your turnover should be at least 200 plus.
How important is it to take into account the macro environment before selecting the stocks that you want to buy?
The best times to invest actually is when the macro environment is not looking very good. Now, this is a little counterintuitive, but historically, equities has been a mean reverting instrument. What I mean by that is that there are phases when you deliver significantly superior returns. Between 2003 and 2007, for example, markets delivered 40-45% compounded. From 2008 to 2010, markets delivered a 25% CAGR on the negative side. But if anybody was investing in 2009 and 2010, when the market environment seemed to look very bad, today the guy would have been sitting on 3x, 4x at an index level. The best times to invest are periods when the market sentiment is very negative.
So that brings me to the next question about market sentiment. Currently the markets are quite high, so how should one take into account the market sentiment before purchasing stocks?
In a very, very euphoric environment, I think I would avoid increasing allocations to equity, but I don't think we are anywhere close to euphoric. I think currently the retail participation in the markets is abysmally low. Vis-a-vis its historical highs, we are at a very low participation level. Yes, the markets have run up a little bit over the last 2, 3, 4 months, but they're not very euphoric. Abysmal market sentiment is actually the best time, as I said earlier, to increase the allocation, but very difficult to do. Very difficult to do. Markets are more or less in between, and there I think we should go stock by stock, sector by sector. Which are the stocks that you like? Are those stocks giving you an opportunity to buy at the opportune time, at the right time, right price?
So far we've talked about the quantitative factors of fundamental analysis, but what are the qualitative factors that one should take into account while doing this analysis of any company?
Please look for companies which are in a opportunity space which is growing and has visibility of growth over the next 8-10 years. Look for companies which have been able to build some kind of a competitive edge in that business. Look for companies where the management gives you a lot of comfort. For example, corporate governance, disclosure norms, steadiness, stability of the management team. These are important parameters. Just ensure that you do not go for companies, whatever be the temptation, which have very high debt to equities. They are generally the biggest, or they're some of the biggest mistakes that people make in the markets. A broken balance sheet is very difficult to fix.
A lot of importance is giving to buying of shares, but what about selling of shares, which is equally as important as buying? So what is your view on the exit strategies?
See, exit is very, very individual led. For example, if I'm a 20-25-year-old guy, I don't recommend exiting stocks or exiting equity allocation. But let's say some stocks or some sectors have had their run. For example, telecom. I think the entire telecom story seems to have panned out. Sectors like that, stocks like that, you might want to churn your portfolio. You might want to move from, let's say, telecom to a growing space, maybe like IT. IT is still growing. I think there is still visibility of the next 10-15 years in terms of growth. But if you're young, I don't think you should exit equity allocation. You might want to move out of certain stocks and move into different. If you're nearing retirement, or if you're nearing a very important financial goal in your life, then you might want to reduce your equity allocation depending on the cash flow needs that you have. Do not typically exit on bad days, on this bad sentiment, on when the markets are not doing well. If you have to really exit, and if you have time on your side, try to exit when the markets are euphoric. Try to exit when markets are doing well.
A lot of people have very high expectations when it comes to the returns from equity market investments. But according to you, what is a realistic expectation to keep?
No, I think that's an interesting one, because our expectation from equity is sometimes in terms of returns is crazy. When I talk to people, they believe 18 to 20% is what a lot of people want from the markets, whereas when you're looking at fixed income, even when you're looking at real estate, you are very happy between 8 and 12%. Please don't forget that equity returns are actually tax-free. So post-tax, you're comparing with the alternative of 6 to 7% with 18 to 20% expectation in equity, which I think is a little unfair. One of the reasons again why people make mistakes in equity markets, because your expectation itself is very high. I think anything close to 13 to 14% compounded over an 8-10 year period is a phenomenal return post-tax. It's twice what you would have made in alternative investments, right? And the power of compounding.
And finally, my last question, what is your advice to first-time investors who are trying to enter the stock markets?
If you are a new entrant to the market, either go through mutual funds or stick to very well-established companies like L&T, ICICI Bank, Axis Bank, Infosys, TCS. There are a host of good companies within the Nifty 50 space. Once you get a fair idea, fair understanding of the market over a 2-3 year period, then you can maybe tweak your portfolio and go a little mid-capish. Look for high quality companies in that space. Again, the same rules: good opportunity space, competitive edge, and corporate governance.
All right. Thank you very much for joining us.
Thank you so much.
This brings us to the end of this special series, Get Started in the Market. We hope that over the last 5 weeks, we've helped you understand stock markets better, which has made you smarter investors. Thanks very much for watching, and we leave you with some golden rules of equity market investments.
Do not try and predict the market. Know when to exit And don't let greed drive you. Stay away from trading, especially if you're a beginner. Stick to your stop loss and price targets. Do not get lured by market rumors or hot tips of the day. Don't blindly follow suggestions. Do your own research.